talk about finances. You're all moving here from different countries, and I know you've all got bits of finances in different places. Liam's independent, but he does represent his own business. There's other financial advisors out there, but we have Trinity to explain his relationship. And yeah, so I'll let you get to it.
Brilliant. Thanks very much, Richard. I'm just going to very briefly introduce myself and explain our relationship with Trinity College. And firstly, I'd like to thank Richard for inviting us in today to provide the presentation. I haven't done a slide because I didn't want to get too into the pensions element of it. So it's going to be a very brief overview of financial services, pensions, mortgages, and then any queries that you have. The presentation will only take approximately 15 minutes. I'll have a quick Q&A answer, and I'll also briefly explain what I've handed out and left on each of your desks and how they can be used. So just to explain who I am, my name is Liam Mannion. I work with a company called Rockcourt Financial Services. So what do we do? Well, we're what's called an intermediary. We are pension and investment advisors. We provide specific advice to public sector bodies, such as Trinity College, UCD, Maynooth, or BIA, various state agencies. Now, why do we particularly focus on these areas? Well, public sector pension schemes have changed considerably over the last number of years, and it's a very, very specialist area. Not many advise on it. And it was an area that we got into in 2010 after the financial crash. So what we do is we provide, firstly, advice on pensions, but also advice then on any financial products that you have questions on. And over the last number of years, we had a particular focus for people who had worked abroad, had moved to Ireland, and what happened to their pension? Where did it go? How did they get it? Will I ever get it? When will I retire? And can I bring it to Ireland, or should I leave it there? Those sort of questions. And once we'd answered that question, we had various other questions then. Well, I'm living in Ireland, and I'm paying, does anyone here living in Dublin, crazy rent? How do I go about getting a mortgage? Who do I go to? What banks? What's the process involved? Who can advise me? We deal with that. They were the questions that we answered after we had the pension question answered. So that's who we are. We're a multi-agency intermediary, regulated by the Central Bank of Ireland. We're not tied to any one company. We deal with all the banks, all the insurance company, and we provide specialist advice to public sector staff. That's the first thing. So what I'm going to speak about first is in relation to pensions. Now, I know when most people, we mention pensions, the eyes glaze over. And it gets very boring. But I'm one of the very few people that actually find it quite exciting. So when we, and I'll explain the reason why. For anyone who's worked abroad and paid into a pension, has anyone here worked in the UK, for example? Okay, we have a number of people. Do you know, did you pay into a pension scheme over there? And do you know when you're due to get the benefits or how Brexit will impact on that? No. Well, the process involved is if you've had a pension, it's worth a considerable amount, especially if you've paid into one of these defined benefit schemes. And there's a lot of change. Everyone's aware of Brexit. And the UK, a couple of years ago, came in and they said, well, we're going to increase the retirement age. Now, in the UK, unlike in Ireland, they don't have as much union support. When they make a decision, it's pretty much made overnight. And in some cases, a number of years ago, prior to 2010, we would have always said, leave your pension in the UK. That's fine. So what Rockcourt does to help individuals to make a decision on what is the best advice, the first thing we do is we prepare a report. And so just to explain, our relationship with Trinity in this matter is Trinity first brought us in 2013 to provide advice to staff that have worked in the UK or abroad, advice on their pension. So our relationship with Trinity is we provide advice in relation to their pensions, but we're also administrators of an ABC scheme, which I'll come to in a while. So we've been appointed by the board of Trinity to provide their staff with advice on pensions, ABCs, and if you worked abroad. So now, to go back to your pension in the UK. So you really don't know how Brexit will impact, what it's worth, when you can get it. So what we do is we send over a letter to the UK pensions, to your UK pension scheme. We request details on your pension scheme. How much is it worth? What is the value of it? And they notify us, okay, this is what the value of your pension is. So if you would work for 5 years in the USS on a salary of about 30,000, that pension scheme is approximately worth about 130,000 sterling. Probably weren't aware of that. When you see this pension will pay 200 euros a year for the rest of your life, the actual cash value of that pension is about 130,000. So once we have that information from your previous pension scheme, we then prepare a report for you. So here are your options. So if you're planning on staying in Trinity, we'll say you can buy years of service in Trinity College. You can transfer it over here to Ireland into a personal pension scheme. And we'll say you may be able to draw your benefits at 60 or 65, or we may say to leave it there. But that report, once completed, will explain what your options are, what is the best advice, and every 13 months you get an update on it. So if you leave Trinity, you notify us of your new employer, and we'll furnish your new employer with that information. So you're not leaving your pension details behind. And I'll explain why that's important. In the past, when people retired, they paid into a pension scheme, retired at 60, and they were with one employer. If you have 5 different or 6 different employers, all with different benefits, who's going to pull all that information together for you? And the days of somebody actually doing it for you, you're left to your own devices. You're said, well, if you have a pension in France, and you have a pension in America, and you have a pension in the UK, they're not going to be writing to you to give you the money unless you're notifying them of your change of address each year. And that's what we do. We find out we consolidate all of your information in one area and notify each of your pension providers. The final part of the report will say what you're due from Trinity and how the Trinity pension scheme works. And I don't know if you read the papers on pensions over here, but the Trinity pension scheme, they've brought in a new pension scheme. It's a very, very good scheme. It's called the single scheme. So if anybody here is paying into it, what I would suggest that you do is you contact UCC or Trinity College or UCD, your HR unit, and ask for your pension statement. And once you have a pension statement, now that pension statement will be in Greek. I have financial advisors that struggle to understand it. And what we do then is we will put that into plain English and explain what it's worth to you and what your benefits are and why you're paying into it. So the benefits are very, very good. And some of the benefits of paying into the public sector schemes such as Trinity are that your pension is guaranteed from age 65 or 68. God forbid if you die and you're married, your spouse is entitled to half of your pension. If you have kids, they're entitled up to 1/6 of your pension. So the benefits are very, very good, and it's worth quite a considerable amount of money. So that's the first thing on pensions. So for anyone that has worked abroad, I would suggest that we will, if you can gather the details on who your employer was, once you have that information, we will then send off the letter to the pension scheme to find out when you can draw it, what your options are. Should you transfer it to Ireland? Should you leave it there? Are you only going to stay in Ireland for a few years? If you worked in America, you cannot transfer it to Ireland. America doesn't recognise Irish pension schemes. So they're the various questions that Rockcourt will address for you. And does anyone have any questions on that so far? Yeah.
What about non-European countries?
We deal with all European countries, and there is, for example, in Germany, you can port, it's called passporting of pensions, and it's being further reinforced with new legislation coming in next year. But if you worked in Germany or France, we will find out the value of it and present you with your options, so you can transfer it over.
My question was about outside of it, like
Oh, non-European, sorry. And non-European countries, we deal with them in relation to can you transfer them? Not in all cases, and it depends on the country. So only countries with double taxation agreements. So it depends on the company, and the revenue has a list of countries. So once, but you'd be surprised, we deal with a considerable amount of countries. Now, if they're a non-EU country, such as America, then they won't transfer the pension. If it was with Israel, they won't transfer the pension, and it may be best leave it there. Some of them have better retirement options. You may be able to retire, if it was in Greece, you know, retire at 50, 55, I'd say leave it there. So does that answer your question?
What would you recommend to transfer to Ireland? Like, you know, I have part of my pension in Spain and part of it in Ireland.
Yeah.
And I haven't touched it because I'm afraid all those governments will spend the money and then I won't have any money left.
And that's happened. That is.
It's happening in Spain at the moment. So, what would you see the advantages to have it in Ireland, for example?
The advantage is, I would only recommend the transfer of the pension to Ireland if you're planning on retiring here, realistically.
Okay.
So if you are planning on staying here for a year to 2 years, it may not be beneficial. So if you're going back to Spain in 2 years' time and you plan on retiring there, it may not be beneficial to transfer it over.
But would you transfer from Ireland to Spain?
Well, if you retire, if I had a client and we're doing this, Spain had a very generous retirement age up until 2 years ago. So there was actually a lot of people retiring their pensions in Spain to retire early. Would I recommend a client retire their pension in Spain? Not necessarily. If you're going to live in Ireland, it's better to have the pension here. The reason being is, where do you invest it? You know, if a client has their pension in Spain, where can they invest it in Spain so that they won't lose their money, get a decent return, and they may not be familiar with the rules and regulations in Spain. So if you're in Ireland and you're planning on retiring in Ireland, I'd say bring it here. If you're going to be here for a period of 5 years plus, I'd recommend Ireland. If it's going to be less than 5 years, it may be more beneficial to leave it there. So does that answer your question? Would you recommend what's the benefits of bringing it to Ireland? The benefits of bringing it to Ireland would be, if you're planning on living here for greater than 5 years and retiring here, there's very robust rules and regulations surrounding pension investment. It's probably one of the highest in Europe with the UK. Very good history of pensions in Ireland, although they have increased the retirement age. But if you were planning to go back to Spain within 3 years or 4 years, I'd say leave it in Spain. Yeah.
So basically for me, I'm a visiting researcher here at Trinity, but my main employer is Dublin Institute of Technology.
Yeah.
And I know there's like a kind of a problem that the ITs doesn't support pension for postdoctoral researchers as such. So what can I do in this situation?
In this situation, if they don't allow you into the scheme, you have the option of setting up a private pension yourself. So if DIT have said, we will make a pension contribution on your behalf, you can set up what's called a PRSA, or a private pension, and it's portable. So you can establish your own pension scheme because one is not being provided by your employer.
So that's a fully private.
Fully private. You own it, you control it. Your employer can make pension contributions, but you're the owner of it.
And could you also provide advisory service?
Oh, we do advice on that. We have had cases where some of the smaller ITs, not DIT, where they were more like, you know, leaving cert schools that did third level courses, and they didn't allow them into the pension scheme. It was an old scheme. So we set them up with a private pension scheme. The employer made a contribution, and we provided the advice on it, the reports on it, and liaise with your employer.
And,
yeah.
Where does Switzerland fall into that? How easy is it to transfer? Because it seems easier from European countries.
It is easier to transfer from European countries. It certainly is easier. And the biggest reason it's easier is you don't have any foreign exchange. But yes, it is easier to transfer from European countries because it's been done, and there's what's called an EU passport. Once you go outside Europe, it does get more difficult, and it does get longer. For
And
instance,
Switzerland falls into the same as the European countries or? So they're sort of part of the
so, sorry, can you say that?
Switzerland.
Oh, Switzerland is pension scheme. We've never transferred out of Switzerland. It is quite difficult. The reason being is that the Swiss pension scheme is believed to be better, and my recommendation on the Swiss pension scheme would be to leave it there, simply because of the foreign exchange. The currency is so strong. If it was me, and
You lose money on the exchange.
exactly, you may lose too much on the exchange. We've never transferred out of Switzerland. I had clients that have queried it before, but the best advice, going back a number of years ago, was to leave it there. But we'd be more than happy to get details on it for you and provide a comparison to help you make a decision. Okay, yeah.
You work with Japan too?
No one's ever done a pension query from Japan, but we would, yeah, what we do, if you paid into a pension in Japan and you have, it's the same process that's involved. Would Japan transfer to a pension over to Ireland? I'm not sure, but we'd be more than happy to find out. If they operated on the same level as the US or Canada, they wouldn't transfer it. But what we do in that case, similar to the Swiss pensions, was each year we would get an update from them, provide you with the information, so at least you know when you're due to get it and who to claim it off. That's what we have. Yeah.
I think there is a bilateral agreement between Ireland and Japan. But
There is.
To be Irish citizen. I think.
There is an agreement, but is there a pension agreement? And we've just never done one from Japan before. And would the Japanese authorities regulate the central bank recognize Ireland as a pension scheme? The US, for example, we have double taxation agreements, but they still will not transfer their 401ks. And the UK has just started that process. Just to explain why this is happening, it's hard to move pensions, especially from the UK. In a defined benefit scheme, in a pension scheme that the government pay into every year, it's when people retire, their pension scheme is paid out of the current earnings of that country. So if you decide to transfer your pension, you're saying to the government, how much is that pension worth over the rest of my life, which is based on actuarial values, and you're saying, give me all that money today so I can go. So that costs the governments a considerable amount of money. Now, in the UK, in 2015, they banned these transfers for teachers, for nurses, county councils, and the reason they did it is that if 1% of the people, which happened, transferred their money, it was the equivalent of 55 billion out of the UK exchequer, which is exactly the amount they're looking for from Brexit. So what they did was they put a ban on these transfers for any unfunded schemes. So that would be a teacher, a nurse. What scheme did they not touch? The university scheme. So if you'd worked in the UK in a university, like the USS, that scheme can be transferred over. And the reason it can be transferred is that the USS is what's called a funded scheme, as in they're meant to have a pot of money. Now, to give you an example of what's happened in the last 3 years in the USS scheme and why people should transfer their pensions. The liabilities in that scheme have grown to 35 billion. So the USS came up with a great idea to try to make that 35 billion back over the next number of years. So they said, if people die younger, and if, for example, the economy goes really well for us, and if nobody decides to transfer their pensions out, then maybe in the next 30 years, we might get rid of the 35 billion. It won't happen. So if anyone that would have a pension in this USS scheme, we're recommending that they transfer it because it will eventually be banned. So, but that's the reason why they're banning a lot of these. The governments are stopping a lot of these pensions leaving the countries because they're actually worth so much.
Yeah, so I am a Chinese citizen, so before I came into Ireland, I was working in Italy in university, and I was paying pension there. So, but now I am living in Ireland, and I don't even have a visa to go back to Italy. So is it possible for me to get the pension back?
Yes, it is. If you work for typically less than 2 years, you can get a refund of your contributions in some cases.
But I work for more than 3 years.
Then it depends on the pension scheme. So we would write to the Italian authorities, ask them for details on your pension. And the rule is generally in Europe that if you work for less than 2 years, you're entitled to all of your pension money back, all your own contributions. Now, some pension schemes may allow you up to 5 years. So if you'd work less than 5 years, you'd be entitled to all your pension contributions back. I know in France, we've done that. We've actually had a client that they were trying to buy a house. They were trying to get the deposit together. We sent a valuation to the French authorities on their pension. They'd worked there for 4 years. Their own contributions were 32,000. They got the 32,000 back, which was like winning the lottery, and managed to get their house. So we'd write to the Italian authorities and present you with the options. So what you could do is either encash it and to get the money. So what would have happened is you would have paid money and your employer would have paid money. You're not entitled to the employer's money, but you're entitled to your own contributions. And that's option one. And option two would be that you either transfer it over to Ireland, so at least it stays within you have access to the pension scheme. And you can port it then wherever you wish. It's easy to port it out of Ireland. Yeah.
Questions. So what's the typical window for claiming the money back in the European Union? Or, I mean, probably there's some kind of average number. So 3 years, 5 years.
It's typically, if you have worked for 2 years or less, you can encash the pension scheme.
No, I mean, how long? So if I worked, for instance, somewhere 5 years ago, so am I still entitled to claim that? So there's no window when I can claim it, like on taxes?
No. Pension is for life, or so people believe.
So even 10 years after I can realize it, I can get the money back.
Exactly.
And the second question, so what's the price of your services? So if I'm a person with Trinity College, say.
Yeah.
So
we don't, the only fee we apply is if you're transferring it from the UK, and we may charge up to €250 purely for the administration if you decide to proceed. The fees and charges that we have, for example, on pensions advice, we don't charge for this service. What we do is, when we do how we get paid, college pays. So we do what's called mid-career seminars and retirement seminars. Now everybody here is way too young for a retirement seminar. And we typically get paid, depending if it's a 1 day or a 2 day course, we would get paid 100 to 150 per person. Now, with retirees, and that's how we make our fee, and the college pay us that. Part of our service to the college is that we don't bill the individuals. We provide this advice, and they give us access then to the staff, and they pay us for the seminars. So now, for a mortgage sale, we also don't charge a fee. So I have a good question. I'll come to mortgages in a second. I'll just finish off on pensions first, if that's okay. What I've left on your desk is, I've left a flyer, which is basically details that if you are a member of your Trinity pension scheme, or UCD or DIT, then you can make an additional voluntary contribution, which means, sorry, go ahead.
And what happens if we work in Dublin City University?
It's the exact same. We deal with all the universities. The reason I did this for Trinity, put the logo on it, is this is a Trinity presentation, but we deal with all. And the same principle applies. The pension scheme in DCU. Now, for all new entrants, for anyone that joins a pension scheme, a public sector pension scheme in Ireland, since 2015, it's the same. It's the same in DCU, DIT, UCC, and Trinity. It's been standardized across Ireland. So this flyer just explains what an additional voluntary contribution is. So, for example, if you're a member of the Trinity scheme and you wish to save further towards your pension scheme, this is the product that you go into. It's called a PRSA ABC. And the reason that we put PRSA in front of it is that it is illegal to charge setup fees. So when we went to Trinity, you cannot be charged for setting up PRSA ABC. If you just had the word ABC, you charge fees. But this product, brought out in 2002, made it, the Irish government tried to reduce the cost of pensions. And they said this product, PRSA, it's illegal to charge a setup fee on it. And that's why we recommended Trinity does it and recommends it to its staff. So that's what an ABC is. And that brochure just gives you a brief background of how they work and what they do. Okay? And the main reason that people pay into them is for tax relief. So, for example, for every €100 that you pay to a pension, 40 euros of it is taken off your tax bill, and 60 euros is all you pay out of your net pay. So your tax comes, you pay in 100, your tax comes down by 40, your net pay only comes down by 60. So it's like going to the bank to say, I want to save 100 quid. Okay, give me 60 euro, and we'll give you the rest. Very similar. That's the reason that people pay into pensions. That reason. So all a pension is a long-term savings plan with tax relief. Okay. My board haven't lost anyone so far yet. So that's pensions. So that's generally the service that we provide. Yeah, go ahead.
You mentioned the United States. In the United States, you have those 401ks and you have standard social security tax.
Yeah.
I've worked in the States for 5 years, but only paid the social security tax.
Yeah.
Am I still entitled to any pension payments, or is social security only?
No. In America, you have to have a minimum amount of years paid in for social security to be entitled to a pension in America. In the UK, they've changed it last year. You need to have a minimum of 10 qualifying years to be able to receive a state pension. So to answer your question, no is the answer.
So 10 years.
10 years is standard. Yeah, standard in most countries. And America would have been, when we were 5, they were 10. So they're making it tougher to claim it. Is that okay? Yeah. Okay. So that is pensions. Second thing I'll just move on to is mortgages. And if many of you move to Ireland, and most people now are beginning to, rather than rent, they want to buy. Would anybody fall into that bracket here? Has anyone looking for a mortgage at the moment or thought about buying it? Okay, so I'll touch very briefly on mortgages. At the moment, if you read the papers, property has gotten more expensive. What Rockcourt, what we do, and in relation to how we get paid for this service, is that we deal with all the banks. We deal with AIB, Bank of Ireland, KBC, Permanent TSB, EBS. We deal with all these lenders. And all of them have different rates. And all of them have different gimmicks. For example, Bank of Ireland have brought out the cashback offer. It's rubbish. We'll pay you to take out a mortgage with us. Believe me, they're getting it back on the rate. There's two types of mortgages. There's one where you're buying your first house in Ireland, first time buyer, and there's one where you're building a house, and that's called a self-build. So if there's very little self-builds here, There's only 2 banks in Ireland doing a self-built mortgage, AIB and Bank of Ireland. They're more expensive and they're harder to get, but they do. The most standard mortgage we do is the first-time buyer or someone looking to refinance their mortgage. So when you're probably wondering, what bank should I go with? Which gimmick is the best? Is this only marketing? So our job is to find the best rate and the best mortgage terms for you. So if, for example, somebody comes to us and they say, well, we're looking to borrow 90% of the mortgage, we'll probably only look at permanent TSB, AIB, and maybe EBS. If somebody comes along and says, I'm only looking to borrow 75% of the mortgage or 70% of the mortgage, then we'd look at KBC. Then we'd probably look at AIB. So depending on who and how much you're looking to borrow, our job is to go and to source the best mortgage for you and to cut through a lot of the waffle and say, this is who we recommend you go with. The other option is that you can go to all the lenders, do the work yourself. How we get paid for that then is each mortgage we do, depending on the value, we typically get paid about 500 euros, 0.7, from 0.5% up to 0.75%. That's what we get paid, and it's paid to us by the bank. Most people, a lot of people had queries on the Bank of Ireland mortgage. They're now paying 3,000 if I do my mortgage with them. But when you looked at the rate and the terms, it was working out far more expensive than KBC. Okay, so what we do is we make the application on your behalf, and it's our job to present you in the best possible light. So it's our job to make sure that before we submit the application, we know you're going to get it. We should have a good idea. What happens is, and this has happened a lot over the last year, people apply for the mortgage, they don't have the right deposit, they're either looking for too much or the bank is just giving them bad advice and they don't qualify for the mortgage. That can set you back 2 to 3 to 4 months while you go and get your deposit together. So we deal with all the banks, and our job is to do it on your behalf. Now, how do we set that up? So what we've done over the past 2 years is, this leads me on to the appointment cards. So these appointment cards, I've left one on everyone's desk. And ideally, we can bring these with us if anyone has any queries, questions, and we just need name, address, contact number, but most importantly, an email address. And after today, everyone in the room will get an email from us explaining who we are and what we do. Then, during your stay in Trinity or in UCC or in any of the universities, any financial questions or queries that you have, you can email them through to us. We have financial advisors then that will respond to your query within 24 hours. And if it's technical and pension related, it could be 48. But we will respond to your query within 24 hours, no matter what the query is. So rather than you having to go to banks, trying to find out this stuff yourself, we do it on your behalf. And we're the one-stop shop. So whatever the financial query or question is, we get the answer. And it's by us giving the advice, it's regulated, and it has to be correct. So to go to mortgages, we have done 1 or 2 mortgages. We're currently doing 1 or 2 in the room. And does anyone have any questions, or does anyone have any queries on mortgages? Yep.
Yes, so for mortgages, I've been talking with some agent from Bank of Ireland, but they have raised an important question that they say, in order to get a mortgage, you have to be a permanent worker in some way. But as a research staff, I'm only a contract worker.
Yes, they struggle to understand the difference between a contract worker and a full-time employee. Now that's Bank of Ireland, but I suggest we look at KBC, who actually do more of those for contract employees. They understand the difference. Bank of Ireland, the old-fashioned in that sense, they just don't understand the difference between full-time and contract. It is harder to get a mortgage on a contract. It is.
So I'm working as a full-time contract. So Is it possible or it's not?
It is, to answer your question, yes, it is possible. And I would happily explain to Bank of Ireland the difference between a full-time contract. And just to give you an example, what we had to do years ago, the public sector brought in a contract called a contract of indefinite duration, CID. It wasn't permanent. Sorry, it wasn't permanent. So we had all these teachers applying for mortgages, and they're all being declined. I said, what's going on? It's not a permanent contract. It's a CID, a contract of indefinite duration. But it didn't have the word permanent. So we had to go back to the bank, get them to get onto their legal team and say, go to the Department of Education, will you please put this in writing that you're not going to sack this person in 12 months? Madness. But we'd happily explain that. Happily. Yeah.
There's also a time when you're entitled to become a CID.
There is after 4 years.
So if Trinity is kind of reluctant to provide you with that updated contract, they tend to want to say everyone on rolling contracts.
Yes.
So it's worth sorting that out before.
If you can, but if you can't and you want to buy a house, it's our job to go to the bank and explain it to them. Now, once you're 4 years in the role, and I don't know if this will apply to anyone here, your employer is obliged to offer you a contract of indefinite duration. So once you've got your 4 years, they have to provide it to you. They don't have any wiggle room. That's in your contract. Be buried in it. So once you're 4 years with Trinity College, and this has happened, and some people say that some employers, not saying Trinity, that it's people will be moved around after 3 years. But once you're 4 years in an employment, typically you're entitled to a contract, a permanent contract. Now that may have changed since, I'm not 100%, but I'll check. But if you're 4 years in the role, entitled to it. Does that answer the question?
Yeah. Does that apply like also if your salary or duties have changed?
No, your salary may stay the same.
No, but I mean like if I work, let's say 2 years in one
Position.
or
It would depend. I mean, if you work 2 years in one position and you move to a new position.
So I'm thinking especially for a postdoctoral researcher. So I mean 2 years for one grant or one project, which is certain salary, and then let's say 3 or 4 years onto the other project where, so the salary changed, the project changed, but it's like a postdoctoral researcher as a position.
It's more of an HR question. If you have
Do you
to,
mean
Yeah,
for-
I'd
you
ask
have to apply for a college as a grant and it can get.
Okay.
Yeah.
So
Okay, so
Break,
it really
so
is
there's
different.
been a break,
it's
then
They're-
it's complicated.
they're in and they're reluctant to give them out. So, but you can still buy a mortgage on a contract, so you don't have to worry about that.
Yeah. Any other questions on the
Is it
mortgage?
really just Bank of Ireland that are quite resistant to that, or are the other?
No,
banks?
they have, the banks are tight, when you're on a contract, yes, it is harder
Yeah.
to get a mortgage because they view that not as permanent full-time employment.
Yeah.
But it can be done once it's explained a bit more clearly that this is how there's a lot of people on these contracts. They have been in these positions for years, which sometimes may lead to permanent contracts. But this is what these employers are doing at the moment. So once it just needs a bit of explanation, and when we make an application, that's what the history we give to it. Because when you're a bank and they get the application in, they just see contract. Now for them, it could be a 1 month contract, a 2 month contract. That just needs to be explained to the underwriters in a bit more detail. And that's where we come in, is to provide that background to paint a full picture for the underwriter. And take it like yourself, the underwriters now are seen as very prudent since 2008, lending money. They want to know, okay, is it a 1 month, is it a 6 month? All of that stuff would need to be explained. And the background of it, the employer, who it is, the role, why you'll be staying on. Yeah.
Do you recommend the fixed interest rates of
Yes, well, there's no trackers. I can absolutely, they're gone. The tracker rates went in 2010 when the banks figured out how much they were going to lose on them. So is it good to fix the rate now, or is it good to leave it variable? It seems at the moment it would depend on the fixed rate. So Bank of Ireland and KBC they have good fixed rates, but interest rates are at historically low levels. So if they're charging you 4.5% for 3-year fixed or 2-year fixed, I'd say stay variable, because the EU, we do not seem to be at the moment on an upward trajectory of interest rates, because at the moment central bank rates for holding money is negative. We've never, America has only started after 10 years to increase rates. So America started printing money in 2008, and they kept the foot on the gas and they kept printing money right up until last year, and they're beginning to slow down that now. And what America is beginning to do is increase interest rates gradually. Europe didn't begin printing money until 2013, I think, 2014. So I believe we're still a couple of years away from interest rate increases. But if you can get, so to answer your question, would I fix rates? My own rates, no, I wouldn't. I'd leave them variable. That's a personal decision, because I don't see big increases coming over the next year to 2 years from Europe. Given
To me, it seems quite high. Even 4% or something like that.
it is compared to the European average. By the way, we do a lot of work in Italy. We do work in Germany, and when you look at even the UK, 1.75% of the mortgage rate. That's European rates. Unfortunately, in Ireland, we've only got actually privately owned banks, 3. The rest are all, AIB is owned by the government, EBS, PTSB, they're all government owned. And they're trying to get profitable. So they're actually paying no money. If you have money on deposit, you're getting about 0.45%. The best place for deposit money at the moment is Investec. They pay 0.45. Bank of Ireland, AIB, they're paying 0.25. And you pay dirt on that, by the way. So you're taxed on half of that, or 40% of it. So yes, the rates are extremely high in Ireland, but that's what we're paying for our banking system. The variable rates now, you should be getting them around the 3%.
Yeah. So if I get a 35 years mortgage, so is it possible that when my salary gets higher and I have more savings, I can put more deposits so
yes.
to reduce the years?
Yes, you can. As yes, you can. You can pay off your mortgage quicker.
Yeah.
Yeah. So if you can, that's what people did, 35, 40-year mortgages. And so you can, allows you to borrow more now. And as your salary increases, the idea is that you pay it off quicker and link it to your salary. They're actually, at one stage during the crash, they were talking about intergenerational mortgages. So 80-year mortgages, pass it on to your kids. Let some of them pay for it. So the wizards in Wall Street were trying to figure out, we've lost so much money. How can we create money from nothing? Let's get them to take on a 60-year debt, pass it on to the kids, let the kids pay for some of it, which they've just found a better way to do it. The governments take it on.
Yeah. I have 2 questions. How long does it take to get a mortgage approved?
You can
How
get
long does it last since the bank authorizes you? Then you have to.
Good question. Well, I explain about approval in principle and what it means. Well, I explain very, very briefly. I don't want to run over time. Approval in principle was a gimmick that was brought out in 2005. So what happened was, in Ireland at the time, you had about 10 banks, and they were all competing. Bank of Scotland, Barclays, AIB, Bank of Ireland, Anglo, every one of them competing against each other for clients. And the problem was, once you go to one bank, and there was a bank on every corner, they say, well, we'll drop our rate, we'll do a tracker rate. We'll do a tracker rate minus 0.5% to get you in the door, or a discounted tracker. But what the big thing was to do is, we'll give you approval in 1 hour. And it was just, what approval means is approval in principle. So you come to AIB and they say, well, you have our rates, and that's great. We'll approve you. And you get this warm, fuzzy feeling thinking, I've got approval. That's good. This is great. I've got approval now. I can, you know, I'm definitely going to get the mortgage. There was a marketing gimmick come up in 2005. You can get approval in, I think they do it now in like 2 hours. It doesn't mean anything, because by the time, the first step is, once you send an application to us, our mortgage advisor, Steve Shield, he's worked in the industry, he's far more qualified in mortgages than I am. I don't know that much about them, to be honest. He can tell you more or less how much you can borrow pretty quickly, who you can borrow it from, and that's approval. So we give you a letter to say you have approval. But now you need to find the asset. So say, for example, you get approval for 250,000, and you know yourself, you're allowed to borrow up to 4 to 5 times your earnings. That's it. That's approval. Once you find the property then you have to make your application. Approval in principle doesn't mean that they're going to lend you the money to buy that asset. You then have to go and try and buy the asset. But if you have that property and you submit the application, all approval in principle does is it gives you an indication of how much you can borrow. That's all approval is. If you're, for example, if you have how long it lasts, they'll say it lasts up till February, March, it was 3 months. Now they've pushed it to 6 months because the market is beginning to hot up. They don't want to lose their clients going to other banks. And so mortgage approval in principle is approval by bank to say this is how much you can borrow, potentially, for a property. And it'll last 6 months. But don't feel tied in with that at all. It all depends on the asset. Some of the banks won't lend if you're down in Roscommon. I don't know if anyone here knows Roscommon. It's where I'm originally from.
They won't lend in Roscommon.
So very, very, very hard. We had a mortgage through, and we found out from one of the underwriters, it was actually KBC, the only deal in the cities. Yeah, we're not keen. We haven't lent a lot down there. We don't know that market. But if you're buying one of the city centre locations, which I presume most are, won't have a problem. Some of the banks wouldn't lend down there. Now, that was not wouldn't lend, but it was tougher to get the mortgage. We eventually got that mortgage in Roscommon with AIB. But we tried to get it through KBC, but we didn't do it at the time.
I thought it was 3.5 times your salary, so it's actually 4 to 5 times.
Well, it's for a joint, sorry, for the single person, yeah. Sorry, 3 to 4 times your net income, yes. 4 times your gross, yeah. Sorry, 3 to 4 times your net income.
But if you then sell the house, say for example, because finally you moved to Italy, and you have to pay the mortgage, whatever is left, and you have to pay tax on whatever equity you made.
Yes, so for example, if you buy a house today for 100,000 and you live in it for if you buy a house today in Roscommon for 100,000, and next thing the boom is coming, sitting in Roscommon in 6 years' time, so you have to live in it for 6 years to avoid capital gains. But if you bought an investment property and you sold it next year for 200,000, the profit on that asset is 100,000. You're then liable for capital gains of 33%. Now, if you buy the property as your personal dwelling house and you live in it for a period of 6 years, you don't pay tax on it. It's classified as your private dwelling house, so there's no tax on it. So that's the key. If you buy an investment property, which is not your private dwelling house, it's an investment property, buy a double, $1 million, sell it next year for $2 million, then you'll pay 33% capital gains. Yeah.
One more question. What happens if you have a property in a different country? Are you a first-time buyer here in Ireland?
Yes.
Is your first
Well,
property?
technically you're not.
Yeah, that's why.
Technically, no, you're not. No, it wouldn't be a first-time buyer. There used to be first-time buyers grants here, but I'm not 100% on what the grant situation is at the moment. But we can check it with our mortgage advisor. Technically, you may not be. I'd have to check that with revenue. I don't know the answer I'm not 100% on that answer, but I'll check with our mortgage advisor. Sorry?
Or having a property in another country. Is it only applied for Europe or also?
Technically, anywhere.
And they don't have a way to know it.
Yes, I know.
Well, I presume when you're doing tax returns, you may declare all that stuff. So, but I'd happily sit down with you on a one-to-one.
No, in Europe, yeah. Outside.
Well, if you're doing, depends where you're doing your tax return. If you're tax resident here, you're declaring your foreign income and you're renting it, it would go up in your property. I can talk about that. We're on YouTube here. Does anyone else have any questions? I'm conscious I don't want to go over time. So that's in relation to, the final bit I'll just touch off on is in relation to the final bit is protection. What happens when you get sick? We would recommend the income protection scheme for your employer. So we run one with Trinity College, and for all the public sector, it's a public sector income protection scheme. It just means that if you're in employment and you suffer any illness, injury, or accident, or anything that prohibits you from doing your job, it will pay out 75% of your income. It's the only form of insurance in Ireland that you get tax relief on, the only type. So you're entitled to, if it costs €100 a month, you're only paying 60 because the government are offering tax relief on it. And it's the only form of insurance you can get tax relief on. So it just means that if you do get sick or anything like that, this pays out in lieu of income. How income protection works is, once your employer stops paying you after 3 months or 6 months, the insurance kicks in and it pays up to 75% of your salary for as long as you're unable to work. And it also pays even if you move abroad and you move, say, to Germany and you were still ill and you were unable to work, provided you came back and did the medical once a year, it still pays. So it's one that we do recommend, and we've seen a huge amount of claims go up, especially in the last year in the public service because they reduced their sick pay. In Ireland, you used to get paid for a year, now they pay it for 3 months full and 3 months half. And we've seen claims shoot up, and it has been very beneficial for members that were in it. So
how does that work if you're on a 2-year contract? Do they pay to the end of your contract?
It'll pay for, at the end of it pays for as long as you're working. It doesn't matter the contract. So if you're on a 2-year contract and you believe you can get cover for the 2 years, you just stop it. We've had cases where, say, somebody, a female, where this happened more on the teaching side of it, where they had income protection, they took maternity leave, but then they decided not to go back teaching, and they were a homemaker. And you can still get cover for up to 15,000 a year. So, for example, if you got ill, it could be cancer, it could be anything, while they're living at home, it'll pay up to 15,000 a year to the recover. So, like a form of serious illness, but ideally it's geared towards your working. So it covers it if you're on a 2-year contract, covers it for the 2 years, it stops automatically. But if you're taking up another role, a similar position, you keep the policy in place. Because once you claim on it, or if you, God forbid, you should have to claim on it, definitely never cancel it because you'll never get cover again. It's the hardest form of cover to get because it's the one that most of the claims are made on. People say, what about life cover? People are living longer than ever. There's very few people dying at age 50, between 50 and 60. I know this is morbid, but living up to 70, 80, you're more than likely going to get sick. You're more than likely going to suffer some illness or injury or accident. And it's anything that stops you from doing your job. And that also includes stress, which is quite broad. So is that okay? Perfect. So what I do is I leave the cards with you. I can collect them from Richard later this week or next week. And I want to thank you all for allowing me in today and thank Richard very much for inviting me. Is that okay?